Reliance AMC is launching a new NF4 and they are launching a scheme called Reliance Closed-Ended Equity Fund Series A. The NF4 opens on 15th of November or has opened on 15th of November. It closes on 29th of November, which is on Friday, and it is a 5-year closed-ended equity scheme. The fund manager who would be managing the scheme, Sallesh Raj Bhan, joins us live. Sallesh, good morning and thank you for joining us. Sallesh, first I'm intrigued with the timing of this NF4. You're launching a closed-ended scheme at a time when there is very little appetite even for open-ended schemes.
The beauty is, markets give you chances when the sentiment levels are low. If you really create a portfolio in this environment, you end up getting disproportionately better performances versus if you come up at peak of markets where it's easy to invest in equities.
In your presentation, you're making a case that Indian markets are extremely polarized and that is where the opportunity is. Now, the flip argument or the counter argument here is that the reason why markets are polarized is because earnings are polarized.
It's a very valid argument that for a reason only this polarization has happened. If you just go back a little bit in history, you will find in 2000, because earnings of IT companies were good, markets were polarized towards IT companies. At that point of time, you could buy the whole old economy sector at valuations of possibly one or two top IT services companies. In 2007, a similar thing happened, inverse of that happened, where you saw old economy companies being disproportionately highly valued and you had consumer and pharma businesses available at very low valuations. So markets do follow earnings. But today, if you see, again, it's an extreme case in terms of valuation distortion, where you are finding that only one or two pockets of the market are getting all the valuation. In fact, in a market cap of one large FMCG company, you can end up owning the whole engineering sector in India today. So I think there is truth in the fact that where earnings are, polarizations happen, but opportunities hence arise because the other segments become disproportionately attractive, either on a replacement value basis or on any other parameter. And expectations on investing today in the other sectors are very, very low. So this creates the ability to invest at very good valuations in established businesses.
Sallesh, hi, morning. Talk a little bit about your NF4 as well, which you launched earlier this month.
Yeah, this is the same NF4 which you are referring to. The basic idea here is, we'll try to invest in about 25 to 30 very good businesses. Today they are available cheap because their near-term performances have not been great because of the slowdown in the economic environment. But I think we are seeing substantial shifts happening already in certain macro improvements which are underway. And also that these valuations are much, much below their intrinsic values or much below even their replacement values. So you're having one part of the market available at disproportionately higher index levels and the other segment available at much, much lower levels. Given that you are able to, in this environment, create solid businesses or own solid businesses and create a portfolio versus try and eliminate, the fractured business models which are there, I think there is a good possibility that these portfolios will do well over a period of time.
So is the spread across large and mid caps or is it concentrated towards index names?
Yeah, this is a well-diversified portfolio spread across mid caps and large caps. Today we are finding significantly large value available in the mid cap space. Certain large cap companies are also decently priced. So there's opportunity across all these categories.
If you're confident of investment thesis, why are you putting a lock-in of 5 years?
Yeah, the beauty is, we are trying to create a completely bottom-up portfolio here. We are not going from a point of view of saying that index has 7% weight in a particular stock and you need to own 3%. So the idea is to create a portfolio where the market today is not positioned. This market is completely living on narrowed money, to be using that term, where, money is focused on a select set of businesses and creating value outside it. So you may find these kind of stocks or the stocks which we are focusing on might do well over a period of time, might not necessarily do well every quarter or every month, which is an expectation when you work in an open-ended diversified product.
But 5 years again is a very long time. The cycles could reverse, the cycles could restart and the cycles could take a 180-degree turn.
I don't think 5 years is a very long time. It's very difficult to predict whether it will be the second, third or fourth or fifth year where you will have very good equity markets. What is important to note is that, look at the last cycle, 2003 to 2008. People made a lot of money from 2003 to 2006, but the biggest run came in end of 2006 to 2007. So it's possible that you may have big markets even in the fourth year or fifth year. More importantly, in this product, since we are basing it based on absolute valuations as an important criteria to invest in and not trying to be in the most happening space of the index, I think that itself allows you to be, participating on a value basis and hence doing well over a reasonable period of time.
Sallesh, the only, close-ended experiment in India has been by Morgan Stanley. They came out with a growth fund which failed miserably, and eventually they had to convert and make the fund open-ended. Do you foresee a likelihood like that, given the way the market conditions are pretty fluid and volatile right now?
It is because of these markets only you're getting opportunities. It's very well said, you either get good prices or you get good news. I think today we are getting very good prices across many, many businesses and many sectors. Now, like you said, some close-ended funds earlier might have not have done exceedingly well because they possibly ended their 5-year period in a dismal environment for small cap and mid cap companies. Learning from those, only we have created a flexi cap opportunity here, where we'll invest where the value lies and not from the basis of relative valuation but from the basis of absolute valuation. So I think this is one significant filter or change from any other closed-ended fund you would encounter.
Sallesh, even though this fund has a 5-year shelf life, you will have to start making a portfolio the minute NF4 closes. So if you, let's say, have to construct a portfolio or a fresh portfolio once the NF4 closes, how would you be looking at investing?
Yeah. As I mentioned, there are many pockets where today value is lying, and in these prices there is no growth which is being implied to these stock prices. So we have opportunities one or two sectors which are expensive, sectors like engineering, sectors like capital goods, sectors like, media and entertainment, sectors like, select pockets in IT, mid-cap side of it, mid-cap pharmaceuticals. Then you have auto engineering businesses. So there are many pockets of the market where there is value lying. So the basic idea will be over a 12, 18 month, 24 month period, when you find earnings of these companies likely to rebound because of 3, 4, 5 variables which critically matter, and these stocks do not reflect their growth potential in their current prices, I think that is the approach to doing it. So we will end up with a diversified portfolio across a sector, across say a few sectors in the marketplace, versus what the current diversification with the index offers, where you have significant overweights in or significant higher weights in say consumer and pharmaceuticals or even banking.
So Sallesh, where do you see buying kicking in say the next 1 year? Would it be the beaten down pockets? Would banks, private as well as PSUs see some genuine buying coming in? Or do you think from now up until, the elections, there would be a volatile lot?
Nikki, volatility has become a norm. So it's very difficult to predict where the buying will come in. What I can tell you is the single biggest trigger for equity markets or any equity business per se is the valuation itself. When you're finding disproportionate value lying and you have seen polarization to this extreme, as I said, this has happened 3, 4 times in the last 18, 19 years of my being into equity markets. When you find these phases, you don't have, only money flow which will determine changes of valuations. You can have just a recovery in earnings because the base of earnings of the last 5 years is so small. So that also can, re-rate a lot of these businesses.
Sallesh, in general, are you planning to align your portfolio for a domestic surprise or for a global surprise?
The beauty is, both opportunities exist today. Just go back 6 months in time. You'll realize that US was not in a recovery mode to that extent. Europe was not stabilized. There was fear of a euro breakup and stuff like that. Today you have seen US doing reasonably okay, Europe stabilizing. You have seen on the domestic side monsoons being much, much better. You have seen reasonable good, at least stability in this festival season in terms of auto sales and the few other sectors. And I think if you have over maybe a 12-month period inflation as well as interest rates easing, these could be wonderful markets for the segments we are being focused on.
Sallesh, you're hedging yourself. Give me a clear answer.
Yeah.
How would you bet on the currency? Because based on your domestic outlook or global outlook, you will have to align your portfolio for the rupee volatility.
Yeah, I'll just take you through this. Currency has two components. The only simple visible component to most people is the export opportunity which it provides. The other way is there is also a big amount of import substitution which is underway. And we are finding that creates a lot of domestic demand. Today you can't set up a Chinese project in India today because the currency differentials are so huge. You can't import equipment from outside. That itself creates a domestic opportunity. The beauty of these markets today is many pockets of opportunity are available, and variables like currency, they don't completely shift everything. They do create opportunities which are or advantages to certain sectors, but they also create opportunities in other areas which don't appear so optically attractive.
So if I give you 100 rupees today, how much will you give me back after 5 years?
How much would it be in?
How much will you give me back after 5 years?
Okay, I think it all depends on the markets, but I think these opportunities, as I mentioned, happen or come in once in 5 years, once in 6 years, and you are getting that kind of a distortion in terms of valuations which is available. So I think that opportunity is in front of us for all of us to capture.
Are you confident of beating fixed deposits? Because last 5 years schemes, NFOs or AMCs have even failed to, beat fixed deposits.
Because I'll just take you through last 5 years. There's nothing which is left to go wrong, which has not gone wrong. You had companies going bankrupt, then countries going bankrupt. You had possibly anything and everything which could go wrong. Currencies were moving like stock prices. In that environment, if the index has actually been maintained, I think you have a next 5 years which is not as bad as the last 5 years. I think there is good opportunity in equities.
What's the sense then, Sallesh, that you're getting about pockets which have been holding high? IT, considering the currency trade, has worked really well. You've also got pharma, which has worked really well, as has been the case with select FMCG as well. Does it seem like from now to the next 5 years, names like a Unilever, ITC, Infi, TCS would continue to give the kind of returns that we've seen in the past?
I think, their earnings can grow. Some of these businesses and sectors can see earnings growth at a reasonable pace. They may not be growing at an earlier pace of, 18, 20, 25%. The only challenge is some of these sectors have valuations which are not normal. Whenever I have seen these kind of valuation changes, you look at in 2000, you had consumer companies, certain companies at very high valuations. They stayed there for a period of 7-8 years. After that, when, the old economy picked up. I think the minute you see a little bit of earning shifts in other sectors, you will see normalization of valuation in today's expensive sectors. So I think earnings growth might still be there for these sectors, just that the PE multiples of these sectors will not be there. And the sectors which we are trying to capture will possibly benefit from both earnings re-rating as well as a PE re-rating as we get along.
So do you see cap goods, infrastructure hold high, considering they are the ones which have been, the most beaten out?
Actually, there's been, hospitality as a sector is completely ignored. There's nobody talking about that space where, you have big businesses which are available, having substantial large capacities. So there are many, many sectors. Even in infra, you look at a lot of companies are operating only on replacement demand today. On the infra side, I'm more specifically referring to the engineering and cap good companies. They also benefit from currency. They also benefit from import substitution, which is there in the system. So it's actually that, these sectors do offer tremendous value. Within that, you have to just own companies which have an ROE or a potential to generate a good ROE over a 3-4 year period. I think that is where shareholder returns are likely to be positioned in the next few years.
When you say infra cap goods, would it be large caps or the mid caps that you're talking about?
Interestingly, both pockets have a lot of value. Both pockets have a lot of value. What we are today doing is, we are not imputing any operating leverage when we are calculating their earnings. Because companies who were doing, say, 100 rupees sales last year, today are doing 80 rupees sales. On that, we are taking an operating margin and a net profit. And on that, we are giving, on that low EPS number, we are giving a low PE to these companies. Just take a shift 2 or 3 years hence where you have a recovery in revenue growth, a little bit of modest recovery in revenue growth. You will have profits which are much higher. And on that higher profits, markets tend to give a higher PE multiple for these businesses. And the beauty is none of these businesses are stretched. We are not investing in stressed balance sheets or fractured balance sheets at all. So today we have very good quality businesses, even in engineering and auto and businesses which are available at valuations which are very normal and not reflecting any operating leverage, not reflecting any recovery in growth and generating cash which is still very, very high.